What is the Social Security tax torpedo and how do you avoid it as a retiree? That's exactly what I'm going to answer in this video. But first, if we haven't met yet, my name is Jake Skellhorn. I'm a certified financial planner and the co-founder of Spark Wealth Advisors, where my partner Chris and I help people across the country retire with confidence and clarity. First, we just need to lay some groundwork before we discuss the tax torpedo and an example that I'm going to show to illustrate it. In the US, we have a progressive tax system on ordinary income, meaning that you pay different rates on different portions of your income. These are the tax rates for 2025, and they apply to your taxable income. In other words, your income after deductions. So, for example, if you earn $100,000, you contribute $13,000 to your pre-tax 401k, and you take the standard deduction of $17,000 next year. That means your taxable income is $70,000, which would put you in the 22% tax bracket. And once again, that means on the next dollar that you earn, you'll pay 22%, but not your entire $100,000 of income. So your first $11,925 is taxed at 10%, the next bracket is taxed at 12%, and then finally your last chunk of income is taxed at 22%. And the reason your marginal tax bracket is so important, especially in retirement, is because it helps us drive the decisions of what withdrawals to take for your next dollar of income. As you know, Roth IRAs are taxed differently than traditional IRAs, and taxable brokerage accounts, if you have one, have different taxes that apply to those as well. Speaking of that, let's discuss how Social Security is taxed. Social Security is taxed based on your provisional income. Your provisional income is your adjusted gross income, plus any non-taxable interest, such as municipal bond interest, and then adding in half of your Social Security benefit. So using a more practical example, let's say that you have $44,000 of IRA withdrawals that you're using to live off of as a retiree. You have a Social Security benefit of $3,000 per month or $36,000 per year. Your provisional income in this case, with no other non-taxable interest, would be $62,000. After calculating your provisional income, you can determine how much of your Social Security income will be considered taxable. Using this chart here, you can see that as a single filer, if you have a provisional income of under $25,000, none of your Social Security income will be considered taxable. There's a range where 50% of your Social Security income will be taxable between $25,000 and $34,000 of provisional income. And then finally, if you have over $34,000, 85% of your Social Security income will be considered taxable and taxed at your marginal tax rate that we mentioned earlier. Where I see a lot of people get confused or mixed up online is that they think that they're paying 50% in taxes or 85% in taxes on their Social Security, and that is not the case. That just means that is the portion of your Social Security benefit that will be included in your income and then taxed at your marginal tax rate that we mentioned a moment ago. Just as a quick side note, part of the reason that so many retirees are subject to taxation on their Social Security is because these provisional income brackets have not been adjusted for inflation ever since they came around in 1983. So obviously this is not a super high income in today's world, but that is part of the reason that it applies to so many people. Let's go into a little bit more detail with that example by running a mock tax return. So in our example here, we have our $44,000 of IRA distributions that will be included in our adjusted gross income for calculating our provisional income. We have our gross Social Security benefit, which is $36,000. Here we can see that our tax software is already calculating how much of that is going to be taxable based on our provisional income, which we'll look at in just a moment. And then after our standard deduction, our taxable income is $55,300. Which once again, based on the marginal tax brackets, as a single filer, we would expect to be in the 22% tax bracket. So let's say that you are this person who is living off of $44,000 in IRA withdrawals and your Social Security, and you have an unexpected expense that comes up in retirement. Let's say your car breaks down and you have an extra $1,000 that you need to pull from your IRA. Well, being in that 22% marginal tax bracket, you might assume that that additional $1,000 from your IRA might generate an extra tax bill of $220. But unfortunately, this is where you would be wrong. So going back to our tax software here, we can compare the two side by side. Again, here we have the base case. Here we have $1,000 extra coming out of the IRA. So instead of $44,000, we'll make this $45,000. What the Social Security tax torpedo is referring to is by taking that additional $1,000 from your IRA, you're not just adding $1,000 to your taxable income, you're bringing an additional $850 into your taxable income, because in this example, we're in that 85% bracket for provisional income. So to visualize the tax effect of this withdrawal from the IRA, we can see that yes, they're taking out $1,000, but they're adding $1,850 to their taxable income, And since that is taxed at 22%, you're paying $407 in taxes rather than $220. So if you take that 407 divided by the $1,000 that you took from your IRA, your effective tax rate on this withdrawal comes out to 40.7%. Now, I didn't make up the term Social Security tax torpedo, but I can only assume that this is what they were referring to when they named it. The additional $1,000 of income is creating a sort of tax bomb of sorts by jumping up your effective rate on the distribution from your 22% to 40.7%. Now, it is important to note that the Social Security tax torpedo is sort of a range that you'll encounter as a retiree. It doesn't mean that every additional $1,000 you'll take out of your IRA will be taxed at 40% in this case. You will get to a point where a maximum of 85% of your Social Security benefit will be taxed, and then any additional withdrawals you make will only be subject to your ordinary income tax rate. So to visualize that, just one more quick scenario. If you take out $50,000 from your IRA instead of 45 or 44, you're essentially reaching the limit as to how much of your Social Security benefit can be taxed. So 30,600 is 85% of your total benefit, meaning the next $1,000 that you pull out of your IRA would be subject to your marginal tax rate again. Instead of 40%, you are no longer basically including any more of your Social Security benefit in your taxable income. So that money would just go back down to your marginal tax rate. So now that we understand the Social Security tax torpedo, what are some ways that you can avoid or minimize it as a retiree? Number one is to focus on ways that you can reduce your adjusted gross income, which will in turn reduce your provisional income. One way that you can do this is by doing Roth conversions early in retirement and ideally before you claim Social Security. By converting money from pre-tax IRAs and 401ks to a Roth IRA, you're creating a tax-free bucket that you can pull from for any unexpected expenses that will not have an effect on your provisional income and thus not cause more of your benefits to be taxed. Another way that you can reduce your taxable and provisional income in retirement is by building up a taxable brokerage account. If you followed my channel for any period of time, you've heard me talk about this quite a lot by now. But building up a brokerage account, which is not a retirement account, you'll have additional money to pull from that is not subject to ordinary income taxes, but will be subject to capital gains taxes on any gains that you have. So the common theme here with these first two options is diversifying your tax buckets, having tax-free buckets and after-tax money in a brokerage account to pull from that will have a lesser effect on your provisional income. Another option you have that could minimize the tax torpedo is to delay claiming Social Security as late as age 70. By spending down more of those pre-tax assets earlier on and converting them to Roth, you're also reducing what your RMDs will be later in life. When you have those RMDs, that's essentially going to force more money into the provisional income calculation. So again, by delaying Social Security, spending that pre-tax money down first, that could also help you avoid the tax torpedo. On that last note, one of my previous videos is about several other good reasons that you would consider delaying Social Security rather than claiming it early. If you want to watch that video next, here it is. Besides that, thanks for tuning in. Subscribe to the channel for any future videos, and we'll see you in the next one.